Hey everybody, so today we're going to talk about 5 investment rules for everyone. And as you guys know, I've been investing for 40 years. So these 5 I really thought through, and I have examples of each one. And please pay attention because all are very important. So the number 1 rule is to understand, and that of course is to understand the deal. Now I have been burned on this so many times, I can't even tell you. I invested in an oil well that actually didn't exist. And of course, I invested in a tech company that just went bust and I lost almost $1 million. So what are the lessons that I learned from those things? I have to look back on my own investments and say, what actually could I have done differently? And number 1, never invest in anything that you do not understand. A lot of times ego is at play. And a lot of times when you're making a lot of money, you just are throwing money around. But I'm telling you, from a lot of friends of mine, do not invest in things you do not understand. Invest in things that you understand. Your success rate will go way up. What are the risks and what are the questions that you should be asking? If you don't know, then find people who do know or go on the internet and make sure that you're very prepared for when you're giving somebody your hard-earned money, that you know what the risks are and you know what the questions that you should be asking. Because when you're being sold something, people will never tell you what the risks are. You need to look at the risks. Number 3, what is the overall experience of the investor? This is really important. We're starting to see it now with a lot of people that raise a lot of syndication money on real estate. If the investor doesn't have at least 5 to 10 years of experience or a team of people around, then if I were you, I would pass. You're going to want to invest with people that have done this before and have a track record. That's what the lenders are looking at right now as they start to resize some of these commercial loans. They're starting to look at the experience of the syndicator, and they're actually making better concessions for the ones that have longer track records. 4, what is the end goal? So is this a cash flow play or is this a capital gain? Now, of course, the difference is cash flow is passive income. Capital gain is just like buying a house low and selling it and scooping the equity. And now, of course, you have fees and capital gains tax and all those kinds of things. This is very, very, very different. In my 30s, I had a capital gain strategy. And then by the time I hit 40, I said, enough is enough. I'm tired of continually having to find deals. I'm going to start to park money and make it more of a passive income so I can have the reoccurring revenue and not have to work so hard. Number 5, can you afford to lose the money? Now, just like when you go to Vegas, I go with a certain amount of money. I always go with the mindset that if I don't come back with any, I'm fine. When you invest, you need to have that exact same mindset. Now, I know you're not investing to lose money, but you need to be in a position to where if it is lost, it doesn't set you back financially in other areas. The second big rule is, of course, leverage. This is a huge one that businesses and real estate has over stocks and bonds and those kinds of things. So obviously with leverage, you can do more with less. And what is leverage? Leverage is simply finding a property, let's say for $1 million, and going and finding a bank or a pension fund or a life insurance company or somebody that will lend you 50, 60, 70, 80% of the money. And then you only have to come up with, say, 20%. This is very important because you could have $1 million of cash and buy $5 million of real estate simply by putting 20% down on 5 different deals and having somebody else take care of the leverage or the debt on that exact same business or property or whatever it might be. What leverage does, it increases time, it uses other people and other people's money. So leverage is really OPM or other people's money. So when you guys go to the bank or park your money in a pension or a life insurance company, then whoever is handling that actually has a problem. That's an expense for them. And they actually have to lend it out to people like us in the form of leverage. And that's what I'm talking about. There's no reason that you can't participate in that. So the third thing is good debt versus bad debt. Good debt, of course, is money that's invested in something that's paying you back. In other words, there's a stream of income coming in from that investment. Bad debt, of course, is credit card debt or even perhaps school loan debt. You got to be careful what you're doing because credit card debt right now is somewhere over 20%. On the good debt side, you might be able to borrow for a business at 5, 6, 7, 8%. So a huge difference on the cost of the debt. Number 4, you're going to get greater results with less effort. And what that means is you're going to get the depreciation expense or the tax benefits on the entire asset, even though you might have only put 20 or 30% down. That's huge. You're not going to get that if you pay cash for everything. And then 5, you're going to get paid multiple times, of course. If you're using leverage correctly, you're going to be able to be invested in many things over a period of time as opposed to just one and saving again. And you're also going to have a tenant in there or somebody like a business that's going to be paying you rent, and you're going to have tax benefits, and you're going to be paying down that debt over time. And so you'll get paid multiple times if you use leverage. The third one, which isn't talked about a lot, is compounding. And this is a simple concept. Compound simply earns you interest or money on your money. If you have $10,000 and you were earning 10% on that money, at the end of 1 year, you would have $11,000. If you still made 10% on the $11,000, then of course you would make more money on the 11. You're actually earning interest on your interest. The second thing is Einstein called compound interest the 8th wonder of the world. If you can start to learn how to do this, a lot of people, what they do is they make money and then they pull it back, and they make money and they pull it back, and then they always have to reinvest. Compounding means that you're in for the longer haul and you're making money on your money. As your money's growing, your interest rate is actually making you more money because your principal is growing along with it. So number 3 is the actual formula for the compounding. You have the final, which is the end result, but then you have your principal, interest rate, number, and time periods. And all of those things work with you as opposed to just investing in something, letting it go up and scooping it back and having to reinvest. So what is the rule of 72? The rule of 72 is simply a calculation that estimates the number of years that it takes you to double your money at a specified rate of return. It's actually simple. For example, if your account earns, let's say 4%, you simply divide 72 by 4 to get the number of years it will take your money to double. So in this particular case, it's 18. So if you're making an 8% return, then of course it takes 9 years to double. And the way that it would double, of course, is if you kept it in and it was compounding. And number 5, and probably one of the biggest lessons that I've learned from compounding, is time is on your side. And I think a lot of times, especially with early investors, they see the equity, they scoop it, they put it in the bank account, and they're fighting inflation. But really, time is on your side, especially if you have inflation, especially if your renter or your business owner is actually paying off your debt. The fourth thing, of course, is diversification. Now, this does not have to be in gold and oil and real estate and all kinds of things. It could actually be inside of real estate. So, for example, one of the ways that we diversify is we're invested in Oklahoma, we're invested in Texas, we're invested in Arizona. And of course, we're invested in multiple areas of Texas. So in Texas, Austin is the state capital. Houston's more oil and gas. Dallas is more finance. So you get the point. So you have different cities that you can actually diversify, and each city operates independently. But what you're trying to do here is you're trying to minimize risk. So I've had situations where we've had, let's say, a military base move out of an area and it severely impacted a property. But I also had multiple properties in other areas. So I had one property that wasn't doing great, but other properties that were doing a lot better. And therefore, the positive properties were covering the ones that had the losses. And obviously, you don't want to have any losses. But if you have all your money in one property, then of course, you have a little bit more risk and you're not diversified. Number 2, of course, you're protecting against future losses on some of these other assets. So markets are fickle. They do go up and down. And if you spread your risk out on multiple properties, you can have some doing really well one year and others doing really poorly another, and it'll average out for you and hopefully minimize your risk. For 3, you're actually going to find new opportunities. I find that a lot of people that invest in one thing and they try to hit a home run, they often are very disappointed. We just saw this in crypto and some of the Bitcoin stuff. So this is a problem. What you need to be doing, there's nothing wrong with investing in those things. I actually did as well, but I had a little bit in there. I have a little bit in gold. I have a little bit in oil and gas. I have a little bit in real estate. I have a little bit in tech. And so I've had to learn those other things. And so therefore, you're actually opening your mind to new opportunities. And I think this is one of the biggest issues that Wall Street has as they try to take your money and invest it for you, is they keep you in stocks and bonds and mutual funds and those kinds of things. And they're not even open to real estate, even though the tenant pays down your debt, you get massive tax benefits, and you can grow tax-free through cash out refinances. Number 4, it mitigates short-term mistakes. So what I mean by that is you can make a small mistake. That's okay. Sometimes it's market timing. Sometimes gold will go down or sometimes oil goes up. These are short-term things. You can't look at it that way. You have to look at it from a long-term standpoint. And if you have other assets that are doing really well and you invest in something that actually takes a dive initially, it's not going to be a big deal because it'll be a learning lesson and your other investments are actually covering it for you. And number 5, it preserves capital. Again, just spreading risk preserves your individual capital. And these are long-term strategies, which the majority of people do not do. Most people go in for the kill, they take the upside, grab the equity, they go and buy a new house, they go out and buy new cars, and then they go raise money for the next one. Trust me, from personal experience, that strategy does not work. And then the 5th one, of course, is hold. And I've been talking about this through the whole video, but people that hold get massive tax advantages. If you want to take a look at what the IRS wants you to do, just open the tax code and take a look. They actually tell you, and every one of their tax strategies are long-term tax strategies. They want you to invest in solar. They're going to give you tax credits for a long haul for solar. Number 2, grow with inflation. I always tell everybody, what was the cost of your house that you grew up in? Just think about that for a minute. My mom still owns the house that I grew up in. She paid about 10 grand for it, if you can believe it. And now it's worth somewhere between $700,000 and $800,000. Let inflation grow with whatever you get, because even the Federal Reserve has said that they believe that they should be at 2%. So 2% over 10 years is 20%. So just let inflation work for you. 3, if you do this, you'll have less time and work and you'll have more freedom. Trust me, guys, it's really, really fun to chase the golden ring and hit home runs. I get it. But focus on hitting singles. And in a very short period of time, you're going to have a lot more free time. You're going to have a lot more freedom to be able to spend on your health and your family, etc. Number 4, you're going to have lower costs on a hold strategy. I'm telling you, think about the transaction costs, both on the beginning and at the end, that you have when you're just churning money. The velocity of money can happen lots of ways. And as velocity of money moves through different assets and different transactions, there's fees and commissions that everyone takes. The cost will be significantly lower if you just hold for the long term. And 5, and the last thing, is use the banks to cash out tax-free. And this, my friends, is the best strategy on the planet. Most people know this. If you own a home, you do it through a cash out refinance. That money is not taxed. It's not taxed because it's in the form of debt. So if you can take anything, it doesn't really matter what it is. It could be a business, it could be real estate, and you grow the value and you grow the value, you can actually go get more leverage. The bank is always going to look at the asset as collateral, and they'll lend against that collateral if you create the value. So the value that you create, you can actually pull back out tax-free through a tax-free refinance because, of course, it's in the form of debt. Hopefully you guys enjoyed the 5 investment rules for everyone. We'll see you next time.